Let's take a closer look at amortization, which is simply the systematic repayment of a loan over time. Repayment of a mortgage loan is calculated with a loan amortization schedule, which is just a multi-column chart that lists out each payment required during the period of the loan itself. We do love our charts, don't we? Let's look at an example. Let's say that Xavier took out a mortgage loan for his garage. In his first journal entry, he would debit his cash account and then credit a mortgage payable account. The next journal entry would be for the first installment of the mortgage, debiting both mortgage payable and interest expense and then crediting the cash account. To determine what those amounts would be, Xavier would need an amortization schedule. Normally, he would get that from the bank. If the loan amount was $100,000 over 10 years at 5% interest, what would the schedule look like if he needed to make annual installments of $12,950? To work out the first year's payment, calculate the interest payment of $100,000 at 5% interest. That $5,000 would go in the first interest payment column, and since we know the total payment is $12,950, we can calculate the first principal payment by subtracting that $5,000 from the $12,950, which leaves us with $7,950. This would be the principal payment for year one. Subtracting this amount from the original $100K would give us the first year's loan outstanding of $92,050. We would then use this amount to calculate year two's interest payment and so on. Using this method to calculate each year would give us a schedule like this. By the way, don't worry, I see that look in your eyes. When you get on the job, you'll have access to software that will help you calculate these things. And most of the time, lenders will send you the schedule anyway. I just want to know that you get the logic of how these things are calculated.